One of the guys thought, but at the very end of the lecture, he just said, "Oh, I forgot to push the button." Right, so we begin with commercial banking, and I begin from the textbook of Jeff Madura. Jeff Madura's textbook called Financial Markets and Institutions. You may try to zoom in real big, zoom in a lot. So, Financial Markets and Institutions by Jeff Madura. I'm teaching from 5th edition, and you have which edition?
We have the 8th edition.
Okay, so you're way ahead of the game with me. Alright, so let's repeat some of the basics which I covered last time. Let's provide a systematic survey. Bank, sources of funds. Sources of funds, and when we say in finance and banking sources of funds, we mean financing. We mean financing, and financing refers to the liability side of the balance sheet. So we begin first and foremost. Let's try to write out with red some of these. We begin with depository. In the first depository called transaction deposits. Alright, so with the transaction deposits, first you have demand deposits, and you're all familiar with demand deposits from Rothbard's book Mystery of Banking. This is a deposit which is payable on demand, and the financial institution has the legal obligation to pay it immediately on demand. Now, from a demand deposit, you have a special type of account called checking account. And checking account is simply a demand deposit account with a check writing facility. In other words, it allows the depositors to write a check against the demand deposit. That's why I also call it a transaction deposit. It allows the depositor to use the account for transactions. Most of the time those transactions will be payments, but not necessarily. Alright, one special type of account is called negotiable order of withdrawal. Short standing as NOW. Negotiable order of withdrawal account. Alright, so what is this account? This is a special account that provides checking services, which we also call a checking facility, ability to write check, but at the same time allows for interest. In other words, the history, and I'll be explaining a little bit more of all of these, is coming from the 70s. During the 1970s was an environment of steadily rising interest rates. During the peak in 1980, the Fed had to raise interest rates all the way to 20% short-term interest rates. When interest rates short-term are 20%, and typically demand deposits don't pay interest, consumers, meaning customers, will minimize their demand deposits, and they will shift their funds in what's called interest-bearing accounts. Interest-bearing account. And an interest-bearing account is what it says, an account which allows the depositor to accrue interest on a daily basis. That's how we call it in accounting. To accrue interest. So every day the deposit was there, they accrue interest. So now account is one of the many examples of interest-bearing account. In other words, during the extremely high inflationary environment that allowed for very high short-term interest rates, demand deposits began to decline significantly, and banks had to allow a number or variety of different accounts that allowed interest-bearing accounts, that allowed the accounts to accrue interest. Otherwise, they would lose funds to other institutions like money market mutual funds that both allow to accrue and accumulate interest, and added the feature of writing checks. All right, so in other words, what you have is a competition between different financial institutions. In a high interest environment, there is a competition, and if you don't offer the feature, meaning interest bearing feature, someone else will, and you're going to lose depository base. Alright, so the next is number 2 in red is savings deposits. So savings deposit is usually what is known back in the good old days as passbook savings. The idea here is that you cannot perform transactions on it. The only thing you can do is walk in the bank and deposit money or take money out. So it does not provide for the convenience, and it's not as easy to take your money out, and therefore passbook savings or savings deposit allowed for a little bigger, a little higher interest rate than the typical transaction deposits. Alright, let's see. There is one thing back in the old days called, Reg Q, Regulation Q. And Regulation Q was a restriction that the government provided on commercial banks to offer on savings deposit. So what really happened was, this is one of the greatest examples of so-called the law of unintended consequences, where the government is trying to provide a regulation. This is fundamental to all economics, and this is a perfect financial application where the government, trying to protect a particular group, ends up hurting that group in the form of regulation. The classic textbook example that we always have is minimum wages. Minimum wages are designed to protect the low-earning laborers who may be working for $3 or $4. The government says minimum wage $6.50 now. All right, and the idea is that now the government will be forcing every employer to pay $6.50. Well, what will the employer do when he faces $6.50 minimum wage and the employee is earning only $4? The business lays off the person. So actually the low-earning people actually get laid off and get hurt by that particular regulation. Another example of a regulation which the government provides is maximum rents, rent ceilings. They're known in economics as rent control. They say rent no more than $2,000, and if the market rate is $4,000, then what happens? Well, those that have rent are really happy. They got rent dirt cheap. Or 2 instead of 4, 50%. Well, what if you don't have the rent? Well, if the government says that the price ceiling is below the market clearing price, you're going to get shortages. You're going to have vicious shortages that happened during New York times. So usually when you get the shortages, suddenly you have a lot more people who are totally unhappy because they're willing to pay the market price, but they can't because there are no apartments to rent at the governmentally determined price. So what Reg Q did said, oh, you can't pay more than, let's say, I'm just picking a number, random number here, 5%. But what if the interest rate is 15%? The idea was originally very important, to limit competition between commercial banks that were fighting for deposit funds so that commercial banks would not eat each other. You know, one is offering 15, another one is offering 16, another one is offering 17. They're trying, in other words, you're in a rising interest rate environment and everyone is fighting viciously for deposits, and they are offering up against each other higher and higher and higher deposits. Well, if you're offering a very high deposit like 15, 16, 17%, but the interest rate on your long-term loans that you made 2, 3, 5 years ago is barely 5 or 8 or 10, you are having a negative interest rate spread or margin. You're losing money. So if banks were earning previously 10%, but now they offer 15 to survive, they're losing money. And the government says, oh, we're going to protect you, we're going to put a limit of 8. So no one can offer 8. Well, what's the market's response? Depositors take their money out of the bank and walk away and walk into some other institution. This case is going to be other type of financial institution that is not subject to Reg Q and will move their money there. So, turned out that this Reg Q not only did not help commercial banks, but it actually hurt them terribly because suddenly the money was flowing out of them to some other institutions. Let's say, for example, money market mutual funds. All right, this is a fundamental idea how government, well-intentioned government regulation designed to protect a particular party or entity or group actually hurts them, and this is a good example of it. Alright, so let's see what's one of the characteristics of passbook savings account was that even though by law the bank did not have to pay the deposit, in practice it was always paid on demand. If in practice it was paid on demand, it was interpreted by all depositors as a demand deposit that would be paying higher interest than the actual demand deposit. Alright? So this is one of those issues where it's controversial. Well, is it really a demand or is it really a savings deposit? When the letter of the law and the contract said one thing, but the practice was totally different, there was practically zero enforcement. So relatively controversial where you count these. Do you count them as time deposit or demand deposit? So another version of this will be the so-called automatic transfer service. Automatic transfer known as ATS. So it becomes an ATS account. The idea here is fairly straightforward. You have an interest-bearing savings account that holds the depositor's money, and the interest-bearing savings account is linked with a non-interest-bearing demand deposit account or checking account. These two are linked together. You keep zero balance on the checking account, and if you need to write a check against your checking account, and you write a check for $75, the bank will automatically transfer from automatic transfer service from the savings account, which accrues interest, to the checking account so that the check will clear. Why will the bank do that? The bank will provide it as a service to keep the demand deposits available. In other words, everyone's paying interest on those one way or another. And this is one way to circumvent the legal requirement that historically was that banks cannot and won't pay interest on demand deposit. Well, if you can't pay interest on demand deposit, you always made the balance of the demand deposit close to zero. excuse me, and you maintain a savings account, and whenever necessary, you shift funds over there. So this is what we call financial engineering or financial innovation to evade financial regulation in order to accomplish a business goal. And the business goal is to pay higher interest rate to the customer in order to retain the deposit. You got to understand that if a bank offers, one bank offers 10% and another bank offers 3%, and the bank with 3% does not respond, it will experience the equivalent of a bank run.
Yeah.
And it will be a disaster for a commercial bank that maintains or attempts to maintain, even for a short period of time, significantly below market interest rates. Well, what is market is what other competitive institutions would normally offer. Alright, is that good enough? Alright, so number 3 is time deposits. 3. Time deposits, and the technical instrument is called CD. Now, it turns out that we didn't cover before, there are 2 types of CDs. One is called retail CD, which is sometimes rarely called small denomination CD. And there is the, how they call it, large denomination CD. I'm trying to see large enough. They actually call it in the textbook, interestingly, negotiable CD, which is typically a large denomination CD. Small denomination CD will be $1,000, $2,000. Negotiable CD is a large denomination CD, typically 1 million and 2, 3, 5 million, which is going to be 7 CDs, each 5 million. And the retail CD is understood, implied to be non-negotiable, while the negotiable CD, the large denomination, is actually negotiable. So, you know, understand what is a CD, certificate of deposit, is for a particular amount of money and for a particular maturity. Many banks will offer to redeem means to pay back. You studied from Rothbard what redemption means. To redeem the CD as a service, but they don't have to, and they usually don't do that. But many will offer these as a CD. So sometimes these are called or known as, sometimes they call them conventional CD. Conventional certificate of deposit, let's see what we have is, these 2 will be conventional CDs, alright? So, what is the small denomination, the large denomination is just conventional CD. But besides conventional, you have another type of CD, which is exotic CD. Exotic. So, what does exotic CD means? Means that it is a CD with a particular feature. 1 example, 2 examples which the textbook provides for exotic CD is a bull market CD, and bear market CD. So bull market CD is a CD that provides a minimum guarantee, which is the face value of the CD, and provides participation in a bull market. To participate in a bull market means to get a certain percentage of the return of a bull market if the market goes up. So, if the market goes up 15%, you get 1/3 of it, 5% return. If the market goes up 24%, you get 8%. Or maybe you get half of what the market goes up. So, if the market goes up, you get certain percentage of market gains. If the market goes down, you lose nothing. So this is essentially, what's the nature of this CD? The nature of this CD is simply a deposit with a call option on the stock market. But it's a classic call option. So what essentially the financial institution does is it takes the CD itself, which is 1,000. It computes what's the interest you're going to earn on that CD, maybe 3%, maybe 5%, I don't know, let's say it's 5%. It takes the 5% return, which the bank, will pay you, and instead of paying you the 5%, they buy a call on the stock market, or particular index, NASDAQ, Dow Jones. And if the call gets in the money and makes some money, you get a fair share, your share of the upside on the market. Well, of course, with a bear market CD, the logic is the exact opposite. You get a put on the market. In other words, they take the proceeds, they use the proceeds, meaning the interest that you earn, they use it to buy a put with a particular leverage and other features. And if the market goes down significantly, you actually get to profit out of it. But if the market goes up, your put expires worthless, but at least you didn't lose the principal of your investment.
You just lose the premium for buying.
You just lose the premium, but the premium was financed itself by the interest that you would have otherwise earned. So you're supposed to earn 5%, but instead of earning 5%, they know that will be $50. They buy the option, call or put, and you can make some money out of it if it goes your way, meaning the bull or the bear way, depending on what you bought. All right, is that good enough? All right, so time deposits. One of the characteristics of time deposits is that their overall value is very volatile. One of the reasons that it's very volatile means sometimes a bank can attract a lot of time deposits and at other times may lose a lot of time deposits. The difference of this volatility is caused by the negotiable CD, which are typically $1 million CDs. So in other words, the denomination of the face value is $1 million. And who would be depositing in a CD $1 million? Who would that person be? Sophisticated financial institutions. There's going to be pension funds, insurance companies, possibly money market mutual funds. In other words, they will be professional investors, we call them investors, financial institutions, who know what's going on, and when you're putting for 1 month or for 3 months, you're putting $1 million into a deposit, 20 points or 10 points of interest. In other words, one bank pays 7%, another bank pays 7.1%. The depositor will not hesitate for a second to shift the money from 7 to 7.1. All right? In other words, depositors are extremely interest rate sensitive. And it will shift without hesitation to grab that extra 10 points, 0.1%. All right? This is the reason why these deposits are so volatile, right? So your exam question might be why, time deposits are, the level of time deposit is relatively volatile. In other words, why this depository base is so unstable. An example. You don't have to write it because that's won't be on the exam, don't worry. I'm just giving you a hint how to think about it. Okay, no need to write. All right, let's see what else I have. Oh, I got MNDA. Number 4 will be MNDA. Standing for Money Market Deposit Accounts. Now, the difference is that these do not specify maturity. No maturity. In other words, they will be interest-bearing accounts, but there will be no maturity. All right, that's the fundamental difference. So, what are the features? In other words, what's this characteristic? Number one is limited check writing. What does it mean? It means in a regular checking account, you may write 2, 3, 5, 10, 20, 50 checks. Essentially, you pay a few cents per check for the issuance of the checks, right? I mean, let's say I pay $20 to get 50 checks or 100 checks, and that's it. Here, you got limited. It would mean maybe 3 checks per month. That's it. Only 3 checks per month. Limited is because they do not specialize in processing checks. So they're going to do 1, 2, maybe 3 checks. They don't want to go through hundreds or thousands of checks. So the people that, let's say, businesses won't use these accounts as a normal checking account. So in other words, they still want to force those who are going to use the account as a checking account to write, a check for TV, and cable, and satellite, and internet, and mobile. Whatever your bills are, you're going to use a regular checking account, all right? So this will be limited. Well, what will limited be? Well, limited will be, for example, for your mortgage. Your mortgage is huge. So if on a regular basis you allow 5 more days to accrue interest on your mortgage money, that's not a bad deal, all right? So, for a mortgage, so when you pay for telephone $20, for mobile $15, for internet $30, doesn't matter. But if you're going to be paying $3,000, and every month you're going to be able to gain 5 or 10 days of interest on these $3,000, it can make a little bit of a difference. And some people factor this into consideration, right? Some people are cheap. If they can save $1, in other words, they can earn $1 interest for nothing, why not do it, all right? So, limited 2, 3 checks. Sometimes they just say 10 checks per quarter for 3 months. That's pretty much it. So, you're going to be paying some of your biggest bills out of here. Or you need to pay it out on your credit card or maybe car insurance. In other words, you're going to be making a really big payment. Then you want to keep the money to earn interest till the very last second. And when the payment comes, you write the check. And you still keep earning interest until the check clears. Alright? That's the rationale. But you don't want to begin processing thousands or hundreds of checks every month from each account. Alright, so that's the first feature. The second feature is large minimum balance. Large balance. The idea here is, hey, we're going to be paying you 8% instead of 5 or instead of 3, but you're going to be maintaining significant balances. You're going to be maintaining at least 5,000 or at least 50,000, some large minimum balance. Instead of for a checking account, there is no minimum balance. You can, maintain $2, no big deal, or $20, no big deal. The idea here is, again, the battle for depository funds. What you want to get is attract as much deposits as possible. In other words, there was this perceived shortage of deposits. Let's clarify something else which I've explained before is during the wild and crazy lending boom in Bulgaria, all commercial banks were viciously advertising for loans. Every bank will advertise to give you loans, Loan for this, loan for a car, loan to buy a TV, flat panels TV, loan to buy your mobile, loan to buy furniture, loan to buy anything you want to buy, alright? So, the vicious competition is on the lending side. In other words, what we call on the users of funds. Why? Because during this environment, banks had surplus of funds and they tried to see how to invest them. In other words, how to lend them to retail customers. This is very typical of interest rate environment where interest rates fall. When interest rates falls, usually means that the central bank and commercial banks are into credit expansion mode. When they're expanding credit, there's a lot more credit, or we call it, if you remember a while ago, loanable funds. And the pool of loanable funds expands faster than the economy absorbs, they must lower interest rates, all right? And in this type of environment, usually this is also an environment where monetary reserves of the central bank and the overall reserves of commercial banking are growing rapidly. They grow at 20–30%. In Bulgaria, commercial monetary base and the reserves of commercial banks were growing like 30%. This was extraordinary. And banks were viciously competing to grab, portion of the lending, of the loan market. Well, as soon as resources, the depository base started shrinking, or the reserves did not grow anymore because they weren't coming from abroad, suddenly banks cut off lending, they tightened lending standards, it got extremely difficult. And then all banks in a flash started advertising deposit. Deposit with interest rate, deposit with higher interest rate. If you do this, this, and this, and that, and this, and that, you're going to get higher interest rate. And they began to compete for deposits. All right? So, this is one of those instruments which banks would offer their customers, typically, at least in America, to attract deposits. And one of the ways to attract is say, yeah, we're going to be paying you a little higher interest rate, but you got to maintain a minimum, much larger minimum balance. And the last characteristic I've already explained and repeated 3 times, higher yield. So, higher yield. Alright, so these 4 primary sources are the so-called depository sources of funds. So all of these represent deposits of typically retail customers. They could be also corporate customers. They could be other financial institutions like pension plans and insurance companies and whatnot. But this is these are the depository. And then we have, is it time to take a break? All right, let's take a break. And so far I covered depository sources of funds, which were transaction deposits, savings deposits, time deposits, and money market deposit accounts. Now we continue with non-depository. Non-depository. So let's write out non-depository. And number 5 will be, we continue with number 5, will be Fed funds purchased. Fed funds purchased. You all know what Fed funds is. Fed funds is deposit of a commercial bank at the central bank. And the process of purchasing, essential purchase means borrowed, and usually is borrowed by one bank from another commercial banks. So the interest rate at which Fed funds are borrowed, we call the Fed funds rate. Sometimes the central bank will intervene in the Fed funds market itself in order to influence or determine the Fed funds rate as part of its overall monetary policy. So, purchased or borrowed. So, the market is called Fed funds market is what is called. The interest rate is called the Fed funds rate. Let's see what else do I have. So, this is essentially one of the 2 primary markets for borrowing reserves and is used for what we call in banking reserve management. So, reserve management is the management of available reserves by a commercial bank in order to comply with minimum reserve requirements. So every commercial bank's got to be watching its reserves not to fall below the minimum reserve requirements.
And what's the minimum reserve requirement?
Okay, so minimum reserve requirement is simply a requirement made by the monetary or banking regulator, usually the central bank or usually the law. In Bulgaria, it is written in the law what is the minimum reserve requirement, which is a percentage of all deposits that central banks must maintain as reserves. Now,
do you know the percentage in Saudi?
I don't know percentage in Saudi. In Bulgaria it is 8 to 12%. 8 to 12%. In other words, law provides for 8. Bulgarian central bank requires 12, so it requires more stringent minimum reserve requirements. What is also important to understand that in an environment of a currency board, as is Bulgaria today and as is Saudi Arabia today, even though we're pegged to different currencies, euro and dollar respectively, the minimum reserve requirement becomes the primary tool of monetary policy which the central bank has available at its disposal. So, as you'll study and as we'll study, there are 3 tools of monetary policy, and the minimum reserve requirement is the primary tool when you are in a currency board. We'll get to discuss this a few weeks from now with monetary policy, tools, targets, etc., etc. All right, so what's next? Let's see, next is borrowing from the, they call it Federal Reserve banks. So let's call them for short Fed loans. So this is a commercial bank borrowing from the central bank, and we did even have a name, a very special name, which will be on the quiz, remember?
Loan.
Yes, we call it discount loan. So let's explain the next concept. The next concept is a discount window. This is a concept from central banking, but you know, we're in the topic. So discount window is a facility provided by the central bank to commercial banks that allows commercial banks to borrow from the central bank in case there is a little bit more than a typical liquidity problem. So when a commercial bank has difficulties, which is not a day-to-day, daily liquidity problem, the commercial bank can borrow from the central bank. The whole facility, with all the procedures and everything, is called the discount window. This is the facility. The loan which the central bank provides to the commercial bank through the discount window is called the discount loan. And therefore, from here, the interest rate which the commercial bank pays to the central bank for a discount loan is called the
Repo rate.
Now, discount rate will probably get to repo in a minute or two, or 5 minutes, all right? So, the discount rate is the interest rate which a commercial bank pays. So, now begin to see we have a number of different rates, right? Of course, let's clarify, just to be sure, from the previous, from a few minutes ago, we have retail CD, and you also have the wholesale CD, or small denomination, large denomination. Of course, they will be paying different interest. So you have a retail CD rate, and you're going to have a wholesale CD rate. So each of these will be having a little bit of a different interest rate. All right, so let's see, discount rate. All right, so what are the characteristics of these loans? So the first characteristic of these loans is that these are typically short term. How do you know these things? That they're short term, huh? It's in the book? Well, of course, I'm also reading it from the book.
I'm reading my
All right.
notes.
Huh?
I'm reading my notes.
You're reading your notes. Very good. What's the second characteristic? Let's see if you got the same as I do. It requires Fed approval. It is a facility which is provided as a courtesy by the central bank to a commercial bank, just like a mother will occasionally provide funds to her daughter or son in financial trouble, right? But it does not represent the rights of a commercial bank to go and ask. In other words, the commercial bank has no right to go and say, give me $100 million loan. If the central bank chooses, in other words, it's a discretion of the central bank, and it's a facility to help and facilitate. But it just don't have the right to go and ask the central bank for money. All right? Well, now the central bank these days with the bailouts is offering them billions and billions, but it's a whole different story altogether. And it is only associated with temporary liquidity problems. Sometimes it may go as far as seasonal liquidity problems. Some banks might have certain particular loan. The loan structure is such that they will have seasonal problems. Alright, so we call these unanticipated shortage of reserves.
Like the financial crisis, for example?
Well, yeah, but not really. Usually the bank may have some very, very large depositor who would want to take the money out. Or some other unforeseen, so unanticipated, associated with unforeseen circumstances, which suddenly the bank faces a shortage of reserve and it's unanticipated. One of the key characteristics is that commercial banks should not go too often to the central bank, meaning too often at the discount window to borrow, because if they begin to borrow too often, this means that they're not managing their liquidity appropriately. In other words, they should try to find longer term, more stable sources of funds than going to the discount window. Usually it means liquidity mismanagement. Alright? Usually going too often to the Fed for a discount loan is a bad signal. So discount loan provides a signaling to market participants, including other financial institutions and other commercial banks and the central bank, that if this bank is coming 50 or 60 times this year for a short-term loan, well, something's fundamentally not right. I mean, you could go maybe 1, 2, 3 times a year, but not 20, 30, or 50 times per year. Alright, 7 is repos, which you're all familiar with. And here the textbook clearly specifies on the first level that it is the sale of securities, but at the second level it usually specifies that these are typically government securities. So the repo is usually highly graded, low risk, investment grade, usually AAA securities of very short-term maturity. Short-term maturity is necessary so that their value is not sensitive to changes in interest rate in the very short run. All right? You understand that 1 month security, even in a wild swing of interest rate, will have a tiny little fluctuation in its price. When a 10-year security, a tiny little change in interest rate, the price will move widely up and down. So, short-term interest rates, fixed income securities have very low volatility. Long-term have very high volatility. And for repo deals, you almost always require extremely short-term securities. Maybe 1 month, maybe 3 months, maybe up to 6 months. Alright, so usually the repo is done for a few days. 1 day, 3 days, 5 days, very, very short term. Second, the securities are used as a collateral. You'll understand that. And we have what is called Fed funds brokers. Fed funds brokers. Fed funds broker is a financial institution which specializes in brokering or intermediating borrowing and lending of Fed funds, which also refers to the previous up there. So usually when a business has surplus of Fed funds, it will approach a Fed funds broker, and if it has a deficiency, we call it shortage, it will approach it, and the Fed funds broker will facilitate Fed funds borrowing and lending, but it will also facilitate repos, because in the end, repo is about satisfying minimum reserve requirement. In other words, Fed funds brokers facilitate reserve management. Again, reserve management. In other words, these are brokers not only for Fed funds from number 5, but for other instruments that will satisfy reserve requirements. Alright, let's see. The other characteristic of a repo, which I have taken a note, is a $1 million block. So it is $1 million blocks. So you can't just borrow for 50,000 or 77,000 or whatever. You borrow 1 million, 2 million, 50 million, 100 million, 200 million, whatever, but it's got to be rounded up to a million. And let me see what else I have. Alright, so this is also considered the yield to be a little bit less than Fed funds rate, because these are secured with high-grade short-term securities, and the Fed funds loan is typically unsecured loan. Alright? So this is an unsecured loan, this is a secured loan. So if this is a secured loan, it will carry lower risk and therefore will carry a lower return than this one over here. Alright? Alright, let's see anything interesting. So, if you read from the textbook, Fed funds broker match up firms or dealers that need funds with those that have excess funds. Alright?
Is it the same, what they call it, broker call loan?
No. Broker call loan is a completely different financial instrument. A call loan or broker call loan is a loan made by a commercial bank or by an investment bank to a broker, and that call loan is used as margin and given to retail customers who will be using that, now we call it a margin loan, to buy securities on margin. So commercial bank, let's say commercial bank, broker, retail customer. Commercial bank will give to the broker a call loan, and the broker will give to the retail customer a margin loan. When the customer borrows money from its own broker to buy securities on margin, we call it margin loan, but the broker itself doesn't have the money. He's not a lender. He will, in turn, borrow it in the form of a call loan. The call loan means that it has a callable feature. Anytime the commercial bank or the investment bank says, give us our money back, the same time the broker must return the money. If the broker has it, it will return the money without liquidating retail customers' account. If the broker does not have the funds, the broker will liquidate some assets from its own customers. It will reduce the margin loans to pay back to the commercial banks. So usually brokers will provide a clause in the contract that will say, in case, the loan has to be returned or blah, 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 we reserve the right at any point in time to call back. So the margin loan, its nature to the retail customer is, in turn, callable. So when commercial investment banks have extended too many co-loans to brokers, which in turn have extended margin loans, and these commercial investment banks get in deep trouble, the first source of liquidity is co-loans. They call on the brokers call on retail customers. There's a massive wave of selling which results usually in a stock market collapse and, begins to feed on itself, all right? But this is what a co-loan is. So margin loan is effectively a co-loan made by a broker to a retail customer to buy securities, which is secured by those securities held at the broker, as a custody for the retail customer. All right, is that good enough? All right, let's move. So repo is repo. Let me take a look if I got anything else for the repo. All right, 8, euro-dollar borrowing. So euro-dollar means the deposits in a foreign bank, So it is a dollar deposit, but deposited, let's say, in Great Britain, or in Switzerland, or in Bulgaria. So in London, you will have dollar deposits, and these we call euro-dollar deposits. And an American bank will borrow from a London bank euro-dollars. All right? It's fairly straightforward.
What about depositing in local bank with foreign currencies?
Well, that will also qualify for a euro-dollar. But sometimes it will be called, in America, euro-yen deposit. Now it's going to be calling the most absurd name euro-euro deposit. Right? So, yes, but the idea here is from US-centric point of view. You may have, as we do now here in Saudi Arabia, dollar deposits. An American bank, Citigroup or some other bank, might borrow from a Saudi bank in dollars and down the road return back in dollars. So these, for example, if I have, well, right now I have a euro deposit in Samba, in a Saudi bank. So this will represent a classical euro-euro account, right? So it is a euro-denominated deposit in a Saudi bank.
Euro-real deposit.
Huh? A what?
Not a euro-real deposit.
No. It's just, that's what we call. Euro means it's going to be in the foreign currency. And then when you say euro-yen, means that it is deposited in yen. If you say euro-dollar, means that it's actually dollar. All right? Euro-franc means in francs.
Why does it called euro? Is it started
Euro is called because in the good old days, when the first time happened, it happened in Europe and it happened in London because the US market was heavily regulated. And remember the Reg Q, Regulation Q, that imposed ceilings on deposits? It'd say, well, if they're going to be putting 5% interest limit or ceiling, interest rate ceiling is how it's called, we're going to make a deposit in a London bank. And the London bank has no restrictions or regulations. So early on, historically, they were done in London, which was back then considered Europe, right? And originally it's called, so these are euro dollars, meaning they're dollar deposits in Europe. So these are the early origins of massive use, and euro has been sticking since then for 3-4 decades now. And even though now it sounds a little bit absurd, it has continued to be used. And no one would have thought back then that euro will become a currency, so that now I have a euro-euro deposit.
And London, they deal with pounds.
Yeah, and they deal with pounds and everything else. All right, let's move on. Number 9 is, what do they call it?
Bonds.
Bank bonds. So, you have bonds. The idea of a bond is to provide a long-term source of funds. Usually, long-term sources of funds are typically used for long-term assets. So if you're a commercial bank, what you want to do is to match the maturity of an asset with the maturity of a liability. And if you don't match them, you have a mismatch. And if you have a mismatch, you expose yourself to two things. You expose yourself to interest rate risk, and expose yourself to liquidity risk. Alright? So, what you want to do is finance long-term assets with long-term bonds. Well, which are the typical long-term assets? Well, buildings, machines, equipment, and other stuff. Well, now commercial banks will have long-term assets like long-term mortgages. And they will partially manage the interest rate risk by making those mortgages adjustable. Alright? But what commercial banks will do is they'll finance them short and lend long. In other words, the liabilities will have a shorter maturity than the assets. The assets are long-term. And they'll be riding the so-called yield curve. In other words, yield curve is typically upward sloping. So they'll be paying lower interest rate on the shorter term funds, and they'll be collecting a higher interest rate on the longer term assets. And the difference they'll try to pocket as long as the yield curve is normal or upward sloping. When the yield curve inverts or when interest rates begin to rise, things go terribly wrong. We might get to that a little later. So these are about the bonds, but typically banks try not to use bonds because bonds are considered to be an expensive source of capital. Now, let's clarify the word capital. Word capital has two completely different meanings. One is long-term source of funds, and bankers use it as long-term source of funds. The other term for capital, or the other meaning for capital is equity, owner's equity. The same as what we call or define bank capital. And these are used interchangeably, but they're, you try to use capital certainly to mean bank capital. Alright? So, number 10 is exactly that. Number 10 is bank capital. Alright? And bank capital is what this whole thing is about, the stress testing of banks, right? Which they just released the other day, where the saying is that banks must raise capital of about $70 billion to provide for adequate capital adequacy. So, first of all, we have a number of concepts. One is called primary capital, and the other one is called secondary. Now let's make sure that I get these right. So primary capital is raised by issuing common stock or sometimes issuing preferred stock. And the second primary source is reinvestment of profits. In other words, when bank has earnings during a particular period, the bank's got to do one of two things with the earnings. Either distribute them as dividends, or we call this process capitalize them. To capitalize means to convert earnings into bank capital. We call this to capitalize, which got different meanings from, capitalizing different meanings. So usually capitalization is now the process of converting undistributed earnings or income, not dividend, undistributed earnings or income, which we call profits, into capital. Alright? And the secondary capital is raised by issuing subordinated notes and bonds, in other words, long-term debt. So primary is usually equity, which has usually no maturity, and secondary is of long-term debt.
Which has maturity, right?
Hmm? Well, yes, that always has maturity. All right, so banks always avoid raising capital by primary by issuing stock, and the reason is stock dilution. What is stock dilution? Stock dilution is the increase in the number of outstanding shares, and therefore a proportionate reduction in the value of each share. Because the bank capital or bank has a certain value. If you have 1 million shares, each share is worth so much. If you double the number of shares, each value will be worth half. Each share will be worth half. So we call this process stock dilution. Stock dilution. So bank owners hate to dilute their own stock. So they always try to do any other way but through stock dilution.
If they raise their capital by bonds or securities, they don't dilute their shares?
Yes, if they raise through debt. In other words, do you raise it through debt or through equity? If you issue debt, there is no dilution. If you issue debt, you raise the leverage of the bank. When you raise the leverage, if there are profits, there are going to be a lot more profits for the bank owners. And if there are losses, there are going to be a lot more losses for
shareholders.
the taxpayers. Remember from last time? Privatization of profits and socialization of losses. When losses exceed the bank capital, the losses are transferred to the taxpayers. In other words, the bank will get a bailout. That's why banks hate having a lot of capital. If they have a lot of capital and they suffer huge losses, they aren't going to get a bailout. You know, why bail them out if they have a lot of capital? You want to maintain razor-thin level of capital so that in case you can get a profit, you profit big. But in case you get a loss, you get a bailout. All right? This is the moral hazard. This is the incentive why banks want to get as little capital as possible. So what the regulators do is provide requirements. And we call these capital requirements. Capital requirement is simply a requirement imposed by a bank regulator on commercial banks to maintain a minimum capital ratio. Capital ratio is the ratio of capital to the overall balance sheet of the bank. This is also known and now much more commonly used as capital adequacy. Capital adequacy
ratio.
Yes, adequacy requirement and capital adequacy ratio. Adequacy ratio. This is the ratio of bank capital to the balance sheet that is considered by the regulator to be adequate. In other words, just like you have minimum reserve requirements, this represents minimum capital requirement. While minimum reserves represent one constraint on the balance sheet on the bank to expand its balance sheet, capital adequacy represents a different type of constraint. Now, the nature of banks is credit expansion. So, one way to limit credit expansion is to provide minimum reserve requirements, and banks cannot expand more than the reserves they maintain. The other way is to provide minimum capital or capital adequacy requirements, and if the bank has 1 billion of capital, it cannot expand more than, let's say, 10 billion total for the balance sheet. On the balance sheet, right?
Yeah.
Because once they reach the limit and they're at the capital adequacy ratio, they're going to start working on off-balance sheet ways to expand, all right? credit expansion is in the nature of commercial banks, all right? So let's see what else we have. So we have minimum primary capital requirements. So we have minimum primary capital requirements. Minimum primary capital requirements is essentially that capital adequacy that I was talking about. And then there is minimum total capital requirements. And these will vary from regulator to regulator, from Bulgaria to Europe to the US. But you have these so-called Basel and Basel II regulations. Basel, and now it's Basel II regulations, which is made by International Banking Authority. I don't want to get into that because that's the regulatory side of commercial banking. And usually most countries in the world try to impose requirements equivalent to Basel II or stronger. Bulgarian Central Bank is very fearful due to a banking collapse that we lived through in the late 90s, just barely 10 years ago. So Bulgarian Central Bank is extremely careful and usually imposes all Basel II requirements, and many of them are even more stringent than Basel II. In Bulgaria, commercial banks are so wild and crazy, they feel it's the wild, wild east, that they're expanding in such a crazy manner that central bank has got to keep them in control. Of course, they aren't really Bulgarian banks. They're Austrian-owned banks and Greek-owned banks and Italian banks and Swiss banks, etc., etc. So these are foreign, usually Western banks, which open branches in Bulgaria, and they operate as if they're in the wild, wild west, right? And usually central banks gotta keep them in control, and they gotta sometimes impose much stringent requirement because they can expand credit at 50% annually, and that's unacceptable. All right. Let's see what else. So we have now you have a brand new concept which is called risk-based. Risk-based. Let's see how they call it. Risk-based capital requirements. For example, risk-based capital requirements are well-intentioned, or were well-intentioned originally, where if you are having a low-risk investment, you're going to be providing little capital. Well, what does this capital mean? The economic meaning of capital is a buffer for losses. So, if you have a low-risk asset, whether it's a loan or a government security or a mortgage, you need to provide little capital. If you have a very high risk, you need to provide a lot more capital, all right? So risk-based means that those loans which are very risky, you're going to be providing full capital. Mortgages which are considered a lot less risky will be providing only half capital. All right. For government securities, you provide little capital. For cash, you provide no capital. And for gold, there's technically no, it's perfect reserve, right? No capital requirements. So, risk-based capital requirements usually indicated based on the totally false belief that real estate mortgages are fundamentally much safer because they are backed by real estate, which is ultra safe, and it provided for only 50% capital requirements. So rather than put in a normal capital requirement, you put in half of it. Well, this provided in Bulgaria, as well as in many countries around the world, this mad rush when the bank has not enough capital to expand credit by providing mortgages because it has to set aside less capital when you provide a mortgage as opposed to providing a different type of loan. So suddenly the whole banking system is going crazy about giving mortgages, because they still have a limit on their capital, right? They still want to leverage up the bank as much as they can, and greed, meaning high leverage in combination with capital requirements, suddenly provides super strong incentive to the mortgages. So the whole country is going crazy about mortgages, and what you get is called a mortgage bubble or real estate bubble. And while it lasts, it feels great, but when it bursts, you know, the whole banking system is on the verge of collapse, where it is right now in 2009 anyway, right? So this is actually the current state of the US banking system. That's why they need bailouts in the trillions of dollars. And Bulgarian real estate bubble is going just 2 years behind the US bubble. It would be suffering more or less similar consequences, but if you're in a currency board, bailouts aren't as easy. You can't as easily print money, because as soon as you print money, you violate the parity between euro and Bulgarian currency, and suddenly you jeopardize the stability of the currency. So when you jeopardize the monetary stability, things can go terribly wrong, and we'll do a lot more on that on central bank. This is a typical topic in international finance. All right? So risk-based capital requirement usually means that because of a different level of risk, you will have different requirements of capital, and if a particular asset, you have what we call, let's do this, this is what actually really happened. This is known as, wow, I'm writing only red because these are all fundamental concepts. Regulatory arbitrage. And what I just gave you is a perfect example where regulatory arbitrage means that the regulator requires less than the actual risk. So the risk that the regulator requires is less than the real risk. And commercial banks will arbitrage it by using more of it. So commercial banks will be providing much more mortgage loans because the regulator requires significantly less capital than is the actual risk. All right? I mean, if the regulator said no capital requirement for a particular loan, you can imagine what's going to happen. All banks will madly rush to provide that capital. Now, what you also got to understand is that capital represents a cost to the bank. Just like, you know, any liability for a commercial bank has its cost. You use in corporate finance, have you studied this weighted average cost of capital, right? Well, weighted average cost of capital applies equally well to a commercial bank. So, deposits have their cost, but they're the cheapest cost, and bank capital is a cost, that's the opportunity cost of capital, is a very high cost. So bankers want to use as little capital as possible in their balance sheet, meaning financing or liability, right-hand side structure. All right? So if the regulator provides a little bit less than what their actual risk is, banks will arbitrage it and use a lot more of that particular. So usually regulation can act to distort the overall market, where a little bit less of a requirement than the actual risk will provide strong incentive through regulatory arbitrage to provide a lot more loans in this particular area. Well, you give it enough time to work and you're going to distort the whole economy, getting too many houses in Bulgaria and too little oil wells, for example, or whatever that might be, machines, equipment, etc. Alright, how many more times? I think I'm actually done. So we call these risk-based capital requirement is based on what we call risk-based assets. Risk-based assets. And with this, I'm done for this part. you